I want to know where things stand with HNA. We know the Chinese company is no longer buying SkyBridge, but you either have a joint venture with them or you're talking about a joint venture?
No, we have a signed deal. And so basically what happened at the end of May, when it became clear that we weren't going to get the approval from CFIUS that we thought we needed. I mean, there was a slight chance that we could have ended up with a conditional approval where they would have ring-fenced SkyBridge away from HNA. And so, as you know, in asset management mergers, that's really not going to lead to great business success, because one of the things you want to do is merge the companies, merge the products, and then scale the distribution.
Synergy.
Yeah, exactly, related to those products. So once we realized that wasn't going to happen, we began the negotiation / discussion about keeping a partnership together that didn't need CFIUS approval. And so what we're doing is we have a signed definitive agreement. HNA will market SkyBridge's products in China, mainland China, also Hong Kong. We're in the process of setting up an office with HNA, likely in Hong Kong. And we're in the process of hiring people for that office, to service that office.
Why not register yourselves to sell private securities funds directly to institutions or wealthy individuals in China, the way Bridgewater and Winton have done?
Yeah, I mean, I think it's an interesting way to go. I've always felt that having a joint venture partner that knows the native country better than yourself would probably be better for us. Bridgewater and Winton are larger companies than SkyBridge, frankly. But also, you know, I like the HNA guys. And so the thing about HNA is I think they've gotten a very bad rap publicly. Obviously, one of their founders passed away accidentally last week, which is a real tragedy. I didn't know him personally, but the guys that I know, I've gotten along with very well. And I think that, you know, by and large, what will happen to HNA, in my opinion, is very similar to what happened to Citibank 10 years ago. There's a lot of nasty press about Citibank. It was in an over-levered position coming out of the global financial crisis. But by and large, Citibank had a wonderful world-class franchise, and once it healed itself, it's sort of back to where it was in terms of its imprimatur and reputation. And so I think that will happen to HNA. Okay,
but for the moment, let's acknowledge that this is a troubled company, right? At its peak, 20 times the debt of 20 times EBITDA? It's not a healthy company.
It's very, let me just make this point, though. It's very interesting to me that a year and a half ago, it was perceived by Wall Street and perceived by people around the world.
Be a darling.
Yes, exactly. And so, you know, they did transactions with Blackstone. They bought a big piece of Deutsche Bank. They owned a large position in Hilton. And so when we were talking about merging with them and thinking about them, world-class reputation. And so I think what's happened to them, frankly, is a combination of things. One of them is the over-leverage, and some of it is bad press. But I do think that they're in the process of healing themselves. The good news is they had great assets, and so the process of deleveraging, I think, has been pretty successful for them.
What are your ambitions in China? How much money do you think you can raise there?
It's a good question. I'm not exactly sure, but here's what I do know, that China will be the largest economy by 2035, maybe 2040. Once the capital restrictions come off of China and some of the trade issues dial back, you know, I predict that the United States and China have a great bilateral relationship over the next 25 to 50 years, despite the skirmish that's going on right now. And I think it'll be important for players like SkyBridge to be in China, where, believe it or not, fund of funds is actually a pretty hot product in China. They like the idea of being able to put small minimums, like SkyBridge's minimums are $25,000 and $50,000. And so it's perfect for the mass affluent market there. It's almost like creating a Birka bag for them, if you will, where they can plug into the finest hedge fund managers in the world at a low price.
You really believe it's a skirmish, Anthony, that the approach that the president has taken toward China isn't going to undermine the bilateral relationship and ultimately inhibit market access for companies like yours?
I don't. You know, I could be wrong. You'll invite me back, and we can. I mean, you'll play the tape and say, "Wow, you were really wrong about that." But I don't, because number one, the Chinese think in 50 to 150-year units. The American politicians would probably learn something about that. We don't have any politicians in our country that think in 25-year units of time. But in the 25-minute discussion, There's some trade imbalances. China came into the World Trade Organization in 2001 as a developing nation. There were obviously benefits to them being a developing nation. They're no longer in that category, being the second largest economy in the world. And so they recognize that they have to right-size that. They recognize they have to change that. And I think that they will. I mean, I have said this openly. I don't mind sharing it with you. I think the president's been right as it relates to trade imbalances and trying to correct them and creating more symmetry in trade. But I think some of the bellicosity of the rhetoric has put these politicians on their heels, has made it very tough for them, because if you're excoriating them in public or you're lighting them up on Twitter, and they have constituencies, even in a one-party system like China, if they have constituencies, they've got to get in a defensive posture and show that they're hitting back. And so hopefully underneath this, there's active trade negotiations that are going on between the United States and China, also the United States and EU, and obviously the NAFTA renegotiation. The combination of those things, I'm hoping in the next 6 to 12 months will get resolved and we can get back to focusing on business and growth.
Back to H&A for a moment. What, if any, fallout has there been from the decision ultimately to scrap that deal?
Well, I would say that over the period of time of the uncertainty while we were waiting for CFIUS approval, that ownership uncertainty, unfortunately, in an asset management company, anytime you have ownership uncertainty, institutions and some individuals will start redeeming because they're not sure where the ownership is going and where the direction is of the investment management strategy. And so that 15-month hangover, if you will, probably led to more than necessary redemptions. If you look at SkyBridge's performance, though I can't really talk about it on live television, but if you go to our website, you look at the performance has been exemplary over the last 24 months, and so arguably at the top in the industry. So we'll get that money back. It's just a matter of time. We've already seen the turn in the last 3 months since I returned to SkyBridge. I'm not blaming it on me, of course. It's more related to very, very good performance and related to the uncertainty of the ownership no longer being out there.
How much money came out over that period of time?
About $1 billion. If you look at all the differentials, about $1.7 billion.
And how long do you figure it'll take?
On a net basis.
Yes.
Yeah.
So there were some inflows.
Yeah, there was a combination of inflows and 1.7.
How long do you figure it'll take you to make that up?
It's a good question. I would say, I'm guessing by, I would say 24 months will probably surpass our high water mark.
How much did scrapping the
But we got to have good performance. So let me knock on wood or
That's
my
true.
head or something like that. We got to have good performance. It'll really be subjected to where the performance is.
Well, for a moment, there are ways to look at performance in absolute terms, and there are ways to look at performance in relative terms. In both, what do you consider good? What's good absolute performance? What's good relative performance?
So again, I have to talk generally, but what SkyBridge is delivering is a high single-digit return with very, very low volatility. And so, and we've had a very consistent performance, and we're also, if you look at our book, if you will, we're very interest rate agnostic. In fact, if anything, we benefited from the rising rates. We've positioned the book to take advantage of where we are in the cycle as it relates to the economy. And so it's low beta, interest rate agnostic, but still generating a high single-digit rate of return. And so people that are looking at their bond portfolio, where, you know, maybe the Barclays Ag, I didn't see it this morning, but it's probably down about 200 basis points roughly. If you're looking at a bond portfolio relative to SkyBridge, boy, SkyBridge looks super attractive.
You prefer to compare SkyBridge's performance to the bond index versus the equities index?
Well, let me put it to you this way. I think it's a very big mistake to compare hedge funds, and journalists like to do this for the last 15 years, to the stock market, because we're taking way less risk in the stock market. If you looked at our volatility over the last 24 months has been like a 1.4. Stock market is 3 times that, if you will. So if you're looking for a low volatility return and a high single-digit absolute number, this is a great product for you.
How much did scrapping the deal cost you personally?
In terms of what, like money, you mean?
Yeah.
Well, I mean, I don't really look at it. I own 44% of the company. I still own 44% of the company, and so I didn't get the cash slash liquidity event. But in many ways, I don't think it really cost me anything. In fact, if anything, I think my political odyssey cost me a lot, but I gained a lot from my political odyssey. I think I've become more appreciative of the life that I was living prior to my political odyssey.
Why do you think it cost you something? Or what?
Well,
let me ask it more directly. What did it cost you?
Well, I think, listen, I mean, at the end of the day, I had a very nice, we still have a great business. I was reasonably well known in the financial punditry world and in our industry, in the hedge fund industry. But I mean, to go from that to the White House communications job and out of the White House in 11 days, there was like a lot of notoriety that came with all of that.
It's a good word, yes.
And there was also a little bit of a characterization of me. You know, people try to two-dimensionalize you and frame you in a certain way, which may or may not be true. And so, for me, having experienced that now, it's made me a lot wiser, but it's also made me appreciate where I was and who I really am, which is an entrepreneur and a money manager focused on growing people's money and educating people on the world of finance, as opposed to, you know, I'm not really great at the Washington scene, if you will. Let's just put it that way.
Do you regret it?
No, absolutely not. I think it was one of the best experiences of my life in the sense that it was a great journey. Even though it didn't work out well, entrepreneurs don't regret things. I mean, what they do is they when they get pummeled to the ground like I did, they dust themselves off and they adapt themselves. I mean, there's a great scene, and I'm writing a book, and I talk about my son who's 25. He's about to go to Stanford Business School. It's last summer. He's got his arm around me, and he's asked me, "Dad, are you going to be okay?" And I'm like, not only am I going to be okay, I'm going to show you what entrepreneurs do in a period of distress or a period of a down cycle moment in their lives. And that is, you got to be resilient, you got to be optimistic, and of course, you got to use your sense of humor when things are not going your way.
So you're not going into politics again, by the sounds of it.
No, I mean, I think that I would say, could I help a politician again? Absolutely. Would I be joining an administration or doing something like that? I would say that I think the chances of that are like less than zero.
Less than zero. Why go back to SkyBridge? Why not do
Well, listen,
something
it's
different?
my family's largest asset. Again,
Sure.
I own 44% of the firm.
Well, why not sell it to another firm then instead of
51% of the
HNA?
vote. Well, I don't want to put that kind of stress on the employees. I don't think that that's fair to the employees or the investor base. We've got a stable group of employees. We've been together for 13 years. Senior management at SkyBridge, since the Citibank merger, we effected that merger in July of 2010. We've been together for 8 solid years. So there's been no senior management departure from SkyBridge. The firm has done very, very well. It's got great continuity, and I sort of don't want to put the investor base or the clients through that rigmarole again. Having said that, 5 to 10 years from now, could we look at a strategic conjoining of our assets with another company? Certainly, but I would say that's at least 5-ish years away. Us doing anything like that.
Anthony, you and your co-managing partner Ray Nolte have talked in videos on the SkyBridge website about new products.
Yeah.
What are they?
Well, I'm not ready to launch them, but I'm happy to come back on your show and talk to you about them. I mean, you know, I've got 2 or 3 things that we're incubating right now, but nothing that's fully materialized. I can talk broadly.
Yeah, what kinds of things?
Okay, so we've got a commodities product that we're looking at that we could potentially launch in the fall. We've got a opportunity zones product, which is related to the new tax situation where you can make these investments in inner cities or what the tax code has qualified as opportunity zones, which I think could be a very, very good asset class for SkyBridge because we have the right expertise to do that and we can find the right partners.
What kinds of partners do you need?
Well, you know, you need people with a real estate background, people with a fixed income background, and you have certain positive tax deferrals and tax treatments as a result of the new tax code. I'm sure we won't be the only people that will have a product like that, but I do like that area, and I think it fits our bill of delivering. Again, we're trying to deliver steady Eddie returns in what we think will be an increasingly more volatile market environment.
And these will be funds, or these will be
Funds.
fund of funds?
Yeah, they'll be funds.
You're going to,
Yeah.
so you're going into discrete fund management.
Well, remember we have a dividend value fund. It got Morningstar rank. I think it was the top fund in the last 2 quarters versus 1,300 other funds. So we have a SkyBridge dividend value fund that I'm sort of allowed to talk about.
But you're
So
becoming
good.
less and less of a fund-of-funds manager. In other words.
Well, I mean, listen, I would say 97% of our assets are in the fund of fund space, but could we 3 years from now or 4 years from now have 10 to 25% of our assets away from our core product? I think so, because we've got very good culture at the firm. We have a very good distribution mechanism for raising assets, and I think we can attract core money managers to that platform that are doing very well for clients. So yes, I do think that will happen.
Where are you in assets right now?
A little over 10, probably 10.4 billion.
Where do you figure you'll be 5 years from now?
Well, again, I mean, knock on wood, it'll all be subjected to performance, but I don't think there's any reason why we couldn't double the size of the firm in 5 years. That's a 15% growth, so that's sort of like 7 or 8 from the market, and obviously growing externally, organically through good distribution and adding on products. I don't think there's any reason why we couldn't be a $20 billion firm in 5 years.
Where are you raising capital? You're raising it with H&A in China, or at least that's starting. Where else?
So we're raising money in Korea, raising money in China. We're raising money in Japan, outside of the United States. We have a person that works with us in the Middle East, and so we're in touch with a lot of money from the Middle East. I actually saw you in Riyadh, coincidentally, the day you were interviewing the Prince, and so we're going to be very active in the Middle East. But our core stuff is really here in the United States, where we have a great product for the mass affluent. Again, $25,000 to $50,000 minimums. Sustainable performance with a 90-day lockup, and so it's an ideal product for that market.
That's still your primary sales channel?
That's primary sales channel, and so there's probably 75,000 FAs in the United States across different platforms, you know, whether it's a Morgan Stanley or UBS, et cetera, that have our product offering that they're able to sell to their clients.
What are the economics of that relationship? For every dollar of revenue that you generate in fund-to-fund fees, you keep what, and the FA gets what?
Yeah, it's roughly 50-50.
50-50?
Yeah, roughly.
It's pretty good for the FA.
Yeah. I think it's good for everybody. I mean, again, it's fully disclosed, and if you look at our net number after our fees, it's a very attractive value add for the clients.
Anthony, a number of hedge funds and, well, let's just put it this way, a number of hedge fund strategies and a number of hedge fund managers have performed dismally in the post-crisis period. What do you like right now?
So, I mean, the sectors that I really like are, you know, the whole loan market, structured credit. There's a piece on our website on these TRUP securities, not Trump, but TRUP, T-R-U-P. They're trust preferred assets, where basically you can buy these bond-like products from community and small regional banks that are doing quite well. They have high interest rate returns, good absolute returns. It's a very sophisticated market, and so it's hard to decipher and understand. I think the thing I'm proudest about with SkyBridge, Troy Gajewski, Ray, Robert Duggan, Dan Burrell, our entire team, I'm obviously not going to mention everybody, but our entire team has done a very good job of constructing a portfolio that's not replicable in an ETF. And so I think it's important to distinguish, as everyone's plowing into ETFs, they should have something in their arsenal that's not ETF-like in case something goes awry in the ETF market.
What discarded strategies do you think are going to come back into favor?
Well, you know, when interest rates go up, you know, not to sound cliche, price discovery re-enters the market, and so the long-short managers, ironically, will start doing better. When interest rates are being forced down and you've got quantitative easing going on top of that.
The value guys got crushed.
It's just, it's very, very hard for people to be long something while their shorts are rising alongside of their longs, and so I think that's where the journalists have been critical of the long-short portfolios.
Investors too.
No question. If you step back and look at these indexes, it's 50-ish% long short. It's probably 15% macro. So 60% of the of the exposure is actually tied to the interest rate cycle. Downward interest rates, those sectors don't do well. And SkyBridge, frankly, over the last 10 years have avoided those sectors and stayed more in the event-driven space, more in the what I would call structured credit space, which provided more absolute returns, greater certainty with lower volatility. But, you know, listen, I I think that the obituary that's been written about the hedge fund industry is overstated. It's like what Mark Twain said, the reports of my death have been greatly exaggerated. This industry's got $3 trillion of assets for a reason. They're super smart, sophisticated people in the industry. And with rate normalization, I predict the industry will have a renaissance.
Well, you had almost 800 hedge funds close last year. How many do you figure will close this year?
Not the big ones, though. Yeah, so there'll probably be another 800 that close this year. But what's happening is these are smaller funds on the margin, not doing super well. But if you look at the top 150 to 200 funds, if you will, the ones that Bloomberg frankly ranks, those businesses are doing quite well, and those businesses are transitioning from the founder model into something that's a little bit more institutional. And so I predict that will continue to happen.
What about the fallen angel managers? The Bill Ackmans, the David Einhorns, the John Paulsons. Mm-hmm. What happens to them?
Well, I mean, the good news for the three of them is that they've done very, very well in the space for a very long period of time. So I don't think anybody's having a charity outing for the three of them. If they decide to stay in the business, they're unbelievably smart people. And so each one of them will have a comeback that I think
really? You predict a comeback for Bill Ackman, you predict a comeback for David Einhorn and for John Paulson?
I do, because if they decide to stay in the business, of course,
which is managing money for third parties as opposed to just their own.
Exactly. I mean, of those three, I'm closest to John. And so what I would say about John is that he's a brilliant guy. He built a phenomenally institutionally powered up business. And so even though he's been on the wrong side of certain trades recently, there's no reason why, given what I know of him and the institutional quality of his business, that he can't have a resounding comeback. And so I'm rooting for that for him, because I think he's an awesome guy. I know Bill reasonably well. He's been to our conference. I used to cover Bill when I was at Goldman. This is about 15, maybe not longer, actually 20 plus years ago. And so I have a lot of respect for Bill. And if he stays in the game, he's a winner, and so he'll eventually start winning again. David, I've only met casually, so I can't really comment as much on David as the other two.
He's a value guy as much as anything.
Yeah, I mean, listen, I think here's what happens. You get on the wrong side of something, you're super high profile, the journalists put a spotlight on you, and it can get very nasty. So I experienced that in the political world, so my heart goes out to these guys in the investing world.
Anthony, you've been critical of the president's approach on trade negotiations, right? You have described his...
Constructive.
Constructive.
Yeah, I mean, you guys say critical. I like to say constructive. I mean, at the end of the day, I think he's right on understanding the imbalances, understanding the 75-year asymmetrical nature of trade. And there's a great book on this. Ben Steele just wrote a great book called The Marshall Plan that really lays out what happened in the post-World War II.
There's a difference between analysis and approach and execution. So what we're talking about here is...
Yeah, I would tone down the rhetoric, because I think what the rhetoric is doing, it's putting the other politicians, the EU politicians, the Chinese politicians, and elsewhere in a defensive position. What I find interesting is that the Japanese are the only group that didn't retaliate. I think they're taking a course of action where a little longer term game theory for them.
With the Europeans, though, it's not just about trade, right? The president has attacked Europe verbally, at the very least, and appears to show open disdain for multilateral institutions like NATO, for example.
Well, okay, so again, you got to dig into the rhetoric and away from the superficiality. I think what he's basically saying on NATO, and again, I haven't seen this recently.
We know that he wants everybody to pay their fair share.
Yeah,
but in the meantime, doesn't it become a lose-lose? Look, NATO was the organization that stood up to the Soviet Union and won the Cold War.
When the president said from the White House that it was a august institution and that his feelings about NATO had changed, okay, he did say that about 6 or 8 months ago. I'm sort of anchored to those words. I think he recognizes the need for NATO. He recognizes the need to have a defense line of allied nations. But I think he also recognizes, and this chafes people, but I think he also recognizes that we need to find a way to have a good bilateral relationship with Russia. And so I think that chafes people that he feels that way because of the invasion of Crimea and some of the things that Russia has done in the Middle East, and frankly, some of the things that Russia has done to our European allies
does it
and
chafe you the wrong
their
way?
neighbors. Well, it doesn't chafe me, I guess, because I understand the president's personality pretty. I mean, I think I have a pretty good read on the president's personality. I understand directionally what he's trying to do because he's a bit of a contrarian and he's a bit of an entrepreneur, and he's applying that to the presidency. So he likes to think unconventionally. But I can understand why it chafes other people. But my message to those people would be, let's see how this plays out. If it plays out the way I expect it to play out, and there's a lot of diagrams on the Venn diagram, but the way I think it will play out is that he gets concessions on trade. He develops a reasonably strong bilateral relationship with Russia, which frankly, we had even during the Cold War, and we certainly had during World War II. And so we need to have some kind of harmony, some kind of relationship with Russia, despite the fact that we're natural adversaries in certain parts of the world. And if we do those things, I think that will calm people down. Will calm people down from an investor perspective, and it'll mean less Xanax sales probably. So that'll be bad for certain people in the pharmaceutical industry. But in general, I think it'll be very good for the world.